Okay, let's start. So we discussed in our previous session about life cycle costing. Let me recap for you quickly. So life cycle costing analyzes your product's profitability over life. Product's profitability over life, as compared to traditional costing, which analyzes profitability usually annually. So it also gives us different action plans that we should take, or you can say strategies that we should prepare in order to earn or enhance profitability over the life, enhance profit over life. To understand the life of any product, the life is divided into 4 phases. You remember the phases? First is introduction, second is growth, third is maturity, and fourth is decline, which resembles our human life cycle divided into childhood, adulthood, maturity, and decline is like old age. Okay, so we discussed a bit about it, that there are some cost which is pre-production and there are some cost which are post discontinuation. So those costs usually get untraced under traditional costing, but in life cycle costing these costs will always get accounted, this and this, along with the cost that we incur during the life cycle. Remember this much? So just go through again the meaning, identifying the cost and revenue over a product's life, and it also gives us idea about different challenges and opportunity which require changes in the strategies. So as the product passes through different phases of its life cycle, it faces new challenges, new opportunities, okay, and which also require different kind of strategies to tackle. Objective is to maximize the profit, not for each of the phase but over life. It helps to suggest which strategy the organization needs in order to compete successfully, because in each phase there will be different types of competition, or the product needs to face some competition over its life cycle. So in order to compete successfully, what strategies we should follow, suggest which strategies. So there are 2 things that we learn in objective. We also checked traditional versus life cycle costing. Traditional is about annual basis of profitability, but life cycle is about over the entire life. Traditional is all non-production costs as period cost, but here non-production cost will be traced. Okay, example is like R&D gets written off in traditional, here R&D cost will always be traced. So it shows exact profitability of the product. Here product profitability may get distorted because of some other products R&D cost is getting charged to another product. Why? Because we are not tracing in traditional R&D cost specifically to product. Many a times we may write off R&D as a common expenditure also. So we also discussed about the behavior of our revenue over the different stages. So revenue means sales volume. Basically here we want to say about sales volume, which rises at a very slow rate in introduction stage, but at a very fast rate in growth. It stabilizes at maturity stage and then starts falling. The profit graph is negative in introduction, usually because of high cost and low volume, but in growth it starts becoming positive. In maturity it's at its peak, and towards decline it starts falling and sometimes may get negative. This is profit, this is your sales volume. Okay, so until now we discussed this, right? I asked you to study the characteristics and strategies in different phases, and I believe you must not have studied it, so I will start again. It's very common to assume this. Because of your hectic schedule, it is not possible to do all the homeworks. So we are already carrying so much of backlogs. Sir, what should we do actually? Say today life cycle costing is going on and you give some homework with this, and I am having backlog of previous chapter. So when I get time, I should do backlog or I should do this chapter. Always backlog is to be kept as backlog. If there is a backlog, you should complete it sometime later now. Always try to maintain pace with the current chapter. If you do that, you are better understanding the current chapter. Okay, so if you get time, so you should not start from previous chapter's backlog. Whenever you have to start, you will always start from the latest current chapter going on. Okay, so next we have different characteristics and strategies of our different phases of life cycle. So let's understand this. In introduction phase, there are many characteristics. Characteristics means here what you will witness, as in what is going on in that phase of the product life cycle. And strategies means what plan of action you should execute. So in introduction phase, the characteristics are usually what we will be finding that this is happening is what is happening is we are seeing that the product awareness is being created. Okay, so the more is about identity of the product. Then there is high distribution cost here. Why? Because we are launching the product, so we launch it with a bang. Everyone around us at least must get to know. Okay, then third is skimming pricing. Now what is skimming? Let me explain. I'll explain now skimming pricing. Although skimming is a part of our study in our next chapter, pricing strategies, but still I will explain skimming pricing. The full name is skimming the cream pricing. This is a pricing strategy. Strategy means it's not one time thing, it's continues for a long run. So what happens here is you launch an innovative product, usually which market has never seen before, but market has started understanding the importance of this product and they want to buy. So when you launch this kind of innovative product, it is usually supposed to have very high R&D cost, or you can say launch to market cost. It has very high R&D cost or launch to market cost. Okay, so this cost is usually supposed to be apportioned over the entire life of the product. That means over the entire production that we will do for the product over the life. But who is going to wait so long? Until then, if product dies before then this cost would never be recovered. So what we do is we plan a specific volume of product, a small volume, and we try to recover all our R&D and launch to market cost from that specific volume only, and we try to just sell those product to a specific group of customers who are esteemed buyers, prestige buyers, who give more value to something very exclusive and innovative, who are always eager to pay premium price to possess such product. So what we do is we launch at very high price initially, in order to ensure that we should be able to recover our high R&D cost and launch to market cost from that specific volume launched at high price. Okay, so in this specific volume we earn high profit margin also, and high profit margin is basically a premium margin that we want to keep in the name of brand that we have created. Okay, initially high margin is there, and subsequently when we realize that sales are not increasing further, subsequently when we realize this, that sales are not increasing further, okay, in that case what we do is we reduce the price. Subsequently we reduce the price to attract more market. Subsequently price is reduced to attract more market. Okay, so once price is reduced, what happens? More people start following this product. They have seen a lot in the hands of rich people who possess prestigious value goods, so they start now buying this product. Because of this, you earn now substantial margin, but not in per unit basis. You earn this margin usually in your total basis. So next level gives you more margin. Next level gives you more margin in terms of absolute amount. Low, or you can say moderate profit per unit will be there in this subsequent part. Moderate profit per unit, but volume is very high. Volume is high. Okay, so you get more volume. Volume is very, very high here. You get lot of volume over here. So that way you earn more profit. And lastly, it's your choice that you want to reduce the price to the next level or not. It's your choice, or you may go ahead to reduce the price to capture next level of market, maybe the lower class. All right, so it's your choice. You want to place your brand to that segment of customers also who are very, very price sensitive. So it's your completely own choice. Or you may decide to withdraw the product also. Usually we have seen that innovative products company, what they do, after selling certain volume of their product, they tend to withdraw that particular version of the product and launch a new version. Withdraw means who will actually make so much of loss, right? So what they will do is they'll launch a new version. So they keep their R&D going on continuously. So the moment one product is launched, they will market it, earn some money from it, generate cash from it, and reinvest that, plow back into new design, new variation, and then they will silently withdraw the old one instead of continuously reducing price. So when this pricing strategy is followed, it's called as skimming the cream. Why it's named as skimming the cream? It's just like similar to the process of skimming the cream out of milk. So when you are skimming the milk, you get cream, which we also called as butter. So you get butter. The initial layer of butter or cream is very, very good quality, but the quantity is very less. But if you skim further, what you get is more quantity and average quality also. But if you skim further, third level, you will not get good quantity of cream. Rather, you will not get on any quantity of cream probably. So, you know, even in case of milk packets that we buy for our home, we get different types of milk, like full cream milk. Full cream milk means no butter has been extracted from it. Then we have toned milk, means one time butter has been extracted. Then we have double toned milk, that means 2 times butter has been extracted from it. So if 2 times butter has been extracted from that milk, that means the milk that is left is not having any cream. So that is we call as low fat milk in case of dietary versions. For diet people, they tend to consume more double tone milk than full cream milk. So it is good for old age people also, because usually they are unable to digest a lot of fat. So that's analogy is there. The same analogy is there here while you are skimming the profits from the market using your product. Yeah, what you are using, the analogy for cream, it's the profit. You are skimming the profit out of the market. So first layer will give you lesser amount of profit but higher rate of profit. Second layer will give you higher amount but moderate rate. Third layer will give you further lower rate of profit, but maybe if you are confident enough, higher volume also. If not, they may not give you high profit, you may run into losses. So you may decide to bring up a new version. So what usually Apple does, they actually follow always skimming the cream pricing. So what they will do is always they launch their newest version for a specific group of people, say called as rich class people. For example, iPhone 12 Pro. So they will launch it for introduction. In introduction phase, they will launch it, only create awareness. They'll not try to persuade anyone to buy. They'll only create awareness, and people in that rich class segment, they will pre-book this and will try to get this at the first instance only. This is very, very allegorical here, that nowadays middle class also are showing off like our rich class people, and people who just have salary of 1 lakh rupees a month, they tend to invest 1 lakh rupee a month in their mobile phones nowadays. So never mind, way of living life has changed now completely, doesn't matter. So what happens is they are trying to capture a specific segment who are ready to buy, high price, high R&D cost, high profit margin, and these are the features here which is applicable, and we launch this product for a specific target group. Usually this entire thing represents introduction phase. Okay, so that's what we have here. Pricing skimming is going on in introduction phase. Now skimming starts at introduction. It doesn't mean that it is not happening in next level. Skimming keeps on going throughout the life cycle. It starts at introduction. So what Apple does, it knows that not everyone will buy my product over here. So it started, when they started, they started immediately bringing new versions with their immense R&D team that they already have. So what they will do, sooner they will reduce the price of this. Once they will feel that okay, first range of production has been done, now I'm unable to increase my sales of this particular product, so I'll reduce the price of this. When they reduce drastically, 20%, 30% off. So they'll reduce this 30%. Now what happens? Interesting fact, listen to this. In initial volume, they produce things in very, very high quality. Okay, because they don't want their customers to let down by seeing the newly launched product. So if it by chance gets a bad fame, the market will be gone. So if say by chance iPhone 12 Pro not performing as per standards of iPhone, then possibly, even though customers nowadays, they don't report, but this blog people, blog writers, digital medias, they start screaming around that iPhone got this problem, iPhone 12 Pro, should we buy or not? And people are nowadays buying by reading those reviews. So they will start somehow writing negative things about iPhone. So that is very, very dangerous. So they'll not compromise anywhere in quality here, and initial volume will be produced at very high cost, so high price and say high profit. Subsequently, they will reduce its price, but that will be produced also separately. The next volume will also be produced in a separate lot. It won't be the same phone that was actually bought here. Design is same, but production batch has got changed. So when they produce it again for second time with the same workforce also has learned how to produce it. So they will be able to save time due to, we call this as learning effect. Next volume level will be with high volume. So high volume will also mean that you will be now buying your materials at lower price. So in the same infrastructure, now you will push your workers to produce more. So your fixed cost per unit will also decrease, which we call as economies of scale. You will achieve economies of scale through reduction of fixed cost per unit as well as through decrease in supplier's price. So those savings will come into your cost, as well as what you do is, that continuous improvement you keep on doing. It's not that once product has been launched, your R&D team will stop. You keep changing some internal design. Our exterior you cannot change, aesthetics you cannot change, because that has been accepted already as iPhone 12 Pro. So what they will do is they will reduce some internal design or simplify the design or substitute some parts. Many times what happens, in case of iPhone only, I will tell you, they use a relaunch or replacement strategy to launch their phone. Now what is replacement strategy? So if you want to buy iPhone 12 Pro, you can give us your iPhone 11 or 10 and we will give you 50% cash back in your new phone. So this strategy they follow. So what happens is, you are submitting me your iPhone 10 and 11 and taking a new phone from me. So I get back my phone. So I will of course dismantle that phone and take out all the parts. I will try to refurbish all the parts that I have used over there and use it in our next batch, next lot. So that way I will be saving a lot of cost. So if I am saving a lot of cost, the first beneficiary should always be your customer. Even the last beneficiary should also be your customer. If you are saving on cost, you should always pass it on to your customers. Alright. So pass it on to your customers by reducing price. So what happens is, you will be offering now reduced price. So you will get more volume here than previous, because the same thing is coming. It's actually not the same thing internally, because you might have changed the parts, might have made it a little lighter. Okay, you have also learned by your mistakes in first batch production. So anyway, you save a lot of cost, so you pass it on to your customers. All right, and then subsequently in next stage you further reduce the price to attract more and more buyers. And since you know that you estimate that how many buyers can come, so you can further negotiate with your supplier for better economies of scale, and then the price will go further down. Now subsequent what happens is, in third range, you can say somehow near maturity stage, we stop doing that kind of promotion that we were doing in introduction phase. So we save a lot of cost over there. So all those are given away in the form of discounts to our customers by way of price reduction. So there is again a very low price over here. So low profit margin, but volume is huge. So we earn a substantial profit over here. And now it's our choice that we will allow our product to go into old age or not. It's our choice. We can withdraw and instantly we can launch a new product. So what Apple does, it has analyzed its market into all three segments. Okay, so here there is different target group of customers, TG, here different. So they keep phone for each of the target group. So for rich class they will keep the latest model. For a middle class person, okay, or you can say upper rich class person, they will keep a phone here. So currently we have iPhone 11 moved from introduction to growth stage. And while this has been done, I remember I had bought iPhone 11 in 68,000, and now they have moved it to growth stage. The moment the price has been reduced, okay, that means it is end of introduction stage. So the moment the price was reduced, it was end of introduction stage. Current price is 51,000. Can you imagine? 17,000 they have reduced. So if you see 17,000 reduction, so sometimes we imagine how much profit they are making on one unit. How can they reduce price by 17,000? So it's not about that. Initially, when they have made that phone in the initial lot, it was costing them more. So now the new phones are coming. It's not that old stock being sold at 51,000. So whenever when I was buying this phone from dealers, so dealers were also saying that we have to maintain lots, lot numbers when we are selling you the phone. So if something has come to me at some price, I cannot sell it at discount. It's not allowed. Apple doesn't allow us. So I have to sell my higher cost phone at higher price, else that will be my own loss. So that way dealers talk. So they don't allow their dealers to, of course, sell their high cost phone at lower price. High cost phone will be always sold at high price, or if they are unable to sell, that will be brought back into Apple's factory for recycling purpose. They will send new phone at new price. The batch number will be different. Okay, so they will keep this new phone for a different target group. The entire way production process might have changed inside, components might have changed. Okay, so this lower priced phone usually have compromised durability. I've always seen this case that whenever any phone has been bought, particularly by me, when the price was lowered in subsequent phase, then that product's life was little lesser than the one that was launched in initial stage, because here they don't compromise in quality. Here they'll start compromising. That means the first lot of iPhone 11 that was launched, that must be of the best quality. Now iPhone 11 will be of a little less quality, but still better than any other phone. So that way iPhone 11 will be bought, and they keep again their versions, like iPhone 10 is there, okay, 7 is there, and all those lower version. They don't keep lesser than that. Some version they withdraw from market, you already know, but here some versions they have kept for another group of customers who are very, very price sensitive. So some lower versions are over here, so which people, if they want, they can buy, and they don't want to bring their product to this stage for maybe very low sales stage. So what they do is, they will do what, they keep completing this journey. They will shift iPhone, once they will decide to shift iPhone 11 to this next stage, they'll withdraw a lower version from here. Okay, so that they keep doing, so that every stage of our life cycle has a variation of a product specifically targeted to different income group of people or different group of customers. All right, so what I was sharing is, we keep skimming the market. This is only skimming. First you target your rich class with the best one. So when, say, I'm just targeting the rich class, so middle class and lower middle class or lower class, what about them? Why not earn profit from them? So since Apple has been into market since a long time, so it could now send its previous product to middle class and previous to lower middle class or lower class people. So had it been the first product of Apple, iPhone 12, had it been the first version, Okay, so then it would have been only and only in rich class. If say 11, 10, 7 had not been existing and iPhone 12 would have been the first version, then it would have only been for rich class. Some companies make their products only for rich class. They don't reduce their price at any cost. So they will never reduce, they will immediately withdraw. Once they start seeing decline in sales, they will withdraw and bring upon something new. So you have luxury car companies, Lamborghini, Rolls-Royce, Hummer. So they have a peculiar strategy. They never skim. They just target only the rich class. Skimming is about reducing price to capture more market. Okay, giving a thrust to capture more scale. So skimming is about that. But these luxury car companies are not skimming. They are only targeting the rich group of people. All right. So iPhone is able to target now all three. Apple became the world's most cash rich company only when it launched its big screen size phone, and somehow when it could manage to keep its product variations in all the phases of life cycle. So the day when they decided to keep the product price low and reach to all segments, that decision was taken in Apple, and after that, within short span of time, they become world's most cash richest company. Today also it is the world's most cash rich company is Apple. So it's just because of their product being catered to all the segment across the world, not just in one specific country. So since they are able to handle that level of scale, they are able to manage that cash richness. All right, so I hope you got some understanding about the whole idea of life cycle being implemented in Apple iPhones. So now let us continue with the characteristics further. So you learned skimming. Here competitors buy your product and they start copying. Copying means they will launch basic version of your product. Basic version they will start preparing by copying. Copying is also called as reverse engineering. What is it is called? Reverse engineering. Now what happened, when Apple first launched its phone named i4, 4G. Okay. So that was a very popular phone by Apple, which helped it gain a lot of popularity, because that phone had some very unique features and some good robust hardware also. So competitor like Samsung brought its phone, opened everything, we called it as reverse engineering, and understood how they have made the phone. They copied it and they launched their own Galaxy version phones. The first Galaxy phones was launched by copying Apple's iPhone. Yes, it's a fact. So it was realized by Apple long time later. Until then, Samsung could actually capture a lot of market by, when people were falling for iPhone, Samsung showed its Galaxy phone to all these middle class and lower class people like us. Okay, so what happened? We started buying Samsung's phone. Sometimes we tend to buy second best. Okay, we find second best as the best one many times if we are price sensitive. So we bought Samsung, and which were flaunting Apple. So very less difference you can ever make out. If you are seeing from little distance, you will not realize that it's Apple or Samsung Galaxy. It was quite similar phone. But what happened, Apple that time started fighting with a Samsung as to, you have infringed our designs and some patents also. So what they do to protect themselves from this infringement, they take a lot of patents, like what parts they are using. If they are modifying any parts by using any process, they take patent for that. So they do a lot of patenting to protect themselves from all this copying. This copying happens when you actually grow in scale. You will remember In some shops you will see that say it's written that we have no branches. I've seen in several tier 2 market areas that there is a shop named, say, written as Maria Cloth Store. So Maria Cloth Store, you will find several store named Maria Cloth Store, and everyone has written in bracket, we have no branches. So what happens, one shop if it becomes popular in a small town, so what other people do is they open the same shop, same product, same name also they will give, and same condition they will write. So when any people in the town knows that I bought something from Maria store and it is there in the market, so anyone going to Maria store, they may mistakenly actually go into a different Maria store also. So this copy thing is very popular, but there in that small town, they don't know much about the rights of infringement or the claims that you can have if any intellectual property is infringed or trademark is infringed. So they don't focus on that. But companies like Apple, Samsung, all these actually need to work upon this infringement, otherwise they lose a lot of money, because the people are there sitting to copy everything. So Apple started more focusing on regaining their claims from the infringement. But Samsung, what it did, when it launched this Galaxy phones, they started studying what customer needs, and customer needs were coming as to more about a big screen size phone, and Samsung was the first to keep introducing bigger size phones, and it introduced phones in different screen sizes in a very short span of time, and converted all those customers of its Galaxy phone into big screen size phones, so that now Apple buyers start feeling lower that what phone you are having, see such a small screen, and mine is such big screen. In the meanwhile, Samsung captured the majority market of smartphone across the world, and then the case was heard upon and Apple won the case. There was a huge fine imposed on Samsung for infringement. Samsung didn't mind paying it. It paid because it has already earned a lot of money by even infringing, by selling, several phones, created his own market. But Samsung paid. Apple now started reworking on its phone design, and after some months of that case, they brought a new phone with a big design, and they changed their strategy that now I will not withdraw my old phones so fast. Initially what they were doing, rich, middle, withdraw, rich, middle, withdraw. I'll not withdraw my old phone so fast. I will go into next level of my customer base and keep my some versions for them at very low price, and keep launching new versions at very high price for rich, at some moderate price for middle. They targeted all three customer base, and once when they could actually manage that scale at world level, they became actually the rich class, or basically the cash rich company. And this happened all in supervision of the current CEO of Apple, Tim Cook. Tim Cook is said to be an expert in global supply chain management. Steve Jobs was more towards R&D. He was more into design of operating system or how the phone features should be. But Tim Cook was not towards that. He was towards giving Apple a global presence. So he is said to be an expert in supply chain management, and because of his leadership, Apple could actually manage that humongous scale across the world, keep supplying the phones and achieving the cost reduction targets, and that way Apple could actually become all pervasive. So I hope you have realized a lot of things. There is a question that companies like Rolls-Royce, Lamborghini sell customized cars to their elite customer. Is that skimming? No, it's not skimming. Skimming will be when they will again reduce the price of the same product to capture more market. So they don't do skimming. They just launch it for introduction and withdraw. So the pricing strategy which they follow is called as premium pricing. Okay, it's always at premium. Skimming is when initial will be at premium, then subsequently the price will be reduced. Okay, so anyways, so what are the strategies in introduction phase? Strategies are, you should now strengthen your supply chain. What is supply chain? We have a separate chapter on this, but still for short discussion, supply chain is basically your network of companies covering your suppliers to customers. Network of companies covering suppliers to customers. So right from your suppliers to all your connecting companies to customers, including your dealers, distributors, everyone, or your logistic partners, all the companies with whom you are dealing in order to exist in the ecosystem, it's called a supply chain. So you should strengthen supply chain when you have launched your new product. People are trying it, so you don't induce them to buy, let them get aware about your product, and in the meanwhile, in backend, you try to arrange network partners. That means channel partners like distributor, who will be a distributor in India, who will be a distributor in America, who will be a distributor in China, something like that. You find out the partners and then fix your suppliers, whether they will be able to supply you volume when needed, at what price they can supply, whether they are worthy of working, how the product will be produced, where it will be produced, how the workforce will be arranged. All those strengthening will be done. Then you have to take an action plan of creating more visibility of your product. Then you have to set price as per market. Price as per market is something written for the sake of written, but price is actually decided by us only because it's an innovative product. Anyways, you cannot, of course, set a price something which market can never afford to pay. It's very important to understand. Like in case of Gillette, which I was telling you in my previous day's discussion, the first Mark III costed them before launch $3 billion. So if they would have launched same product with innovative or this premium pricing, nobody would have bought razors. So razors spending capacity has to be seen. So that's how this line is written: set price as per market, induce customer to try, not to buy. Now come to the next, growth strategy. What is the indicator that growth strategy has started? So the moment the price is reduced from introduction stage, it is an indicator that you have entered into growth stage. Okay, price is reduced from introduction stage is equal to indicator of growth stage. So that way, if say question is asked in exam, so how will you identify that growth stage has started? So you will just see the change in price. In introduction, we don't change price, but the moment the price has been reduced, you'll understand the growth phase has started. And characteristics of growth phase is high volume. Of course, now competitors have launched their product. Initially basic version, now full-fledged launch is there. So increased competition. Price reduction is there. Why price reduction is there? Because we want to grow. Grow means we want to capture more volume. Next, new channels to handle growth. New channels is basically create as much channel of sales. Normally channel means channel of sales channel. For example, how will a customer buy your product? Will it be through some reseller? Will it be directly through your website? Or it will be through your some exclusive stores? So who will actually sell your product? Or it may be some online marketplace. So create as much channel as you can. So this helps you to handle growth. That means basically to sell more and try to add new features. Why this is important? Why? Because new features will be visible in this stage, because your competitors are already launching the new product similar to you. So if you add more features, your product will stand different. So That's how Apple does by upgrading its operating system. They keep adding new features in your user experience. And then strategy here should be, you should now induce customer to buy. So you should give them some offers by price reduction basically. Make product available. You may pre-book in introduction phase, but in growth phase actually you should make that available. Have long-term relationships with your partners or customers or suppliers, because now you are not planning to withdraw. You will be entering into maturity phase, which is more volume than the growth phase. So you need to maintain good relationship with them. As regards customers, you will have to have focus on customer satisfaction and quality of your product again. So it's not that only introduction stage will be requiring quality and satisfaction needs to be ensured of. And then you will also promote differentiation features. Whatever extra you have added here, that you need to start promoting, otherwise people won't understand that you have added this. Another is we call as value based pricing, that you can note here. Value based pricing is a new pricing strategy that again we will do in pricing chapter, but still something you should know about this. Value based pricing is, I will price my product, say this is my phone, okay. So in this my phone, I will price it by comparing this product with other phone available in the market, okay. So I'll see what is my next best alternative. If something similar to my phone is coming in say 50,000 rupees, then I will also see what extra features I am giving in my product. So my price will be value of the next best alternative existing in the market plus value of the extra benefits that is provided by my product. That is value based pricing. Okay, what is value based pricing? Value prevailing for next best product plus the extra benefits provided by my product. So that is value based pricing. We'll do it later. Don't scribble everything here. So just note this much. Next is maturity phase. How do you get to know that you have entered maturity phase? So price further reduces from growth. So that means now product is shifting to maturity phase. So you can just Google any iPhone model and see its price variation since launch. So the moment the price reduces, that means it is entering into new life cycle phase. So it's not necessary, by the way, that there will be only 3 times reduction. It's not like that. You can do multiple reduction based on this market scenarios also. So the growth phase may have 2 price reduction also. So that depends again with the volume. So maturity means price further reducing, and here what happens is cost also reduces to minimum. Cost per unit is minimum here. The best part here is cost per unit is minimum. Why? Because now you stop investing on high promotional cost. Okay, you stop investing on high promotional cost. So that way you save on cost and you get large economies of scale benefit because of huge volume. But the problem here is you will see that there is fierce competition all across. Fierce competition means now everyone has your similar kind of product. They are trying to push sales. Overcapacity means sellers are more than buyers. Selling price further reduces. No new channels left, so you have touched all the channels. Everywhere your product is available. Customers move to another product. Customers move to another product. So customers sometimes tend to move to another product because of change in taste and preference. So here you cannot have all your customers only with you. So nowadays many iPhone customers are moving to OnePlus phones, Samsung phones also. So their taste has changed. You cannot do anything. And lastly, what strategies you are following here is strong marketing effort, reduce price to attract price sensitive buyers, huge incentive to channel partners, else they'll start selling competitors' product, start R&D to increase life. Alright, So this also needs to mention here that you should start improve features again. See, here we are adding new features again, but here also, here we are promoting differentiation features, but here again through R&D what we are doing is improve features to differentiate. We start improving features to differentiate. All right. Lastly, it's decline means no more sale is occurring, product is obsolete. Okay, but still some laggard buyers means very late buyers who were waiting for very long time to get the price reach to lowest level. Sales may drop significantly, profits may become negative, even competitors start dropping out, profits may become negative, competitors start dropping out, consumers taste changed completely, so they are not at all looking at this product. In decline stage, what we do is we revive. We start reviving or discontinue the product. Revive means, how do we revive? Reviving is through again extensive R&D. This is only possible through extensive R&D, modification of design, a whole new look, which is as good as keeping the name same and introducing a new design. That's revival. Revival is as good as keeping the name same and introducing a new product, new version of this. That's called as revival. Many times car companies have used revival strategy. So any old model which has already declined and gone out of market, so they keep the same model name and use that model to revive the market for their product. Or they may just discontinue, use the product to launch a new product. That is also new strategy, that you may take it as a replacement policy of new product, that if you have this product then you can sell me and I'll give you discount on my new product. Revive is keeping the name same, just features change, upgrade or design upgrade, but new product means altogether a new product which was not existing. All right, so these are phases wise characteristics and strategies, and tough thing for you is to remember all these point to point. There is very bright chance that you will mix up some of the strategies. General idea you have understood by my discussion, but there is a very bright chance that you will mix up some of the points. In reality, it can get mixed up, but in exam, if you will mix up, they will cut your marks. So that's a big challenge for you. Anyhow, let us solve our one question that we have over here in our DJB book, which I asked you to attempt, and I know that you have not. Still, let us solve. So what is happening here is the company is having 4 products, 4, 3, 2, 1. Question number 6, DJB. Are you with me? So company is having 4 products, 4, 3, 2, 1, and each of them are in introduction, growth, maturity and decline phase. And they are asking that these 12 points are basically having one characteristic and 2 strategies which are applicable for different life cycle phases. So you got to segregate everything like characteristics, okay, and strategies. So 2 are strategies and 1 is characteristic for each of the phase, P4, P3, P2, P1. This table you need to make, which is already given in the question. This table you need to fill up. So for introduction, 1 characteristic is there, 2 strategies there. So let us read and chalk out. Like overcapacity in industry, where did you learn this from me? You can refer your FastTrack books notes. Overcapacity is basically a characteristic of maturity phase. Company can continue to offer the product to our loyal customers at reduced price. So what is this? Company can offer the product to our loyal customers at reduced price. Yes, it's a bit tricky, you cannot help it, and we were shocked to see this kind of question in exam. It's actually tricky, because if it is given as a general comment based, we can always write, but exactly to pinpoint, it is very, very tricky. So nevertheless, we have to do, we can't escape from this. So this happens usually, loyal customers at reduced prices, decline stage, strategy. Now what is strategy, what is characteristic? This is again tricky. Characteristic is you are not doing, you are seeing the situation. Strategy is your action plan. So that way you can differentiate. Few competitors produce basic version of our product. So this is characteristics of introduction phase. Okay. Product features may be improved or enhanced to differentiate our product from that of competitors. So feature improvement is done in maturity phase, strategy of maturity phase. Through R&D, you do feature improvement. Attracting customers by raising awareness about our product through promotion activities. So this is your strategy for introduction stage. You are just creating awareness by attracting. High volume of business. This is basically characteristics of growth stage. Sir, how do you remember all these? Because I have done this in morning batch now. Sir, in morning batch also you remembered? Yes, almost I remembered, because I have done in previous several batches. Use the present products as replacement product. So this you can only tell me is basically a strategy in decline phase. Value based pricing may be considered. So this I shared with you, it's a strategy in growth phase. Profits start declining at times, becomes negative. This is a characteristic in decline phase. Maintain control over product quality to assure customer satisfaction. So this is a strategy for customer satisfaction, strategy in growth phase. Strengthening or expanding channel and supply chain relationships. So this is your strategy in introduction phase. Prices may have to be reduced to attract price sensitive buyers. So this is strategy in maturity phase. So some keywords are there which you can relate, and now the idea is, question is saying that 1 1 1 1 here and 2 2 here. So sometimes you may find something which you are writing 3 here, 3 points here. So that way you can sometimes do some combinations to find out your correct answer. So this needs to be jotted down well in this table. It's already given in this answer over here. You can verify. All right. And then there are two questions which I'll cover up now in our FastTrack book. So I'll not come back to this question. Let's go to our FastTrack book to understand next concept of life cycle costing. I hope this is clear. Some are confusing. I gave you this for your self attempt to help you understand like how far you could make it out by reading the notes. Somewhere something extra which was not written in Savior book, that burden is all mine. Onus of that I will take. Say like value based pricing, you did not have understood if I have not said about this. So if there is a mistake in that, so that onus is mine, not yours. Now next, to talk further, there are some, you write here, types of cost. There are some types of cost, okay, which you will see in different phases of life cycle. So first is, this kind of note is given our new ICAI mat. So I'm just sharing, old ICAI mat did not have this. So types of cost, first is pre introduction, normally what cost comes is R&D cost, marketing cost. You can also say huge distribution cost. Okay, design and testing cost. Then after pre-production, during your introduction, growth and maturity, during your introduction, growth and maturity phase, you have all the material, labor, other operating costs, advertisement cost, and R&D cost may exist here also, but proportion of that cost will be quite less. Lastly, we also have cost. This is also applicable in decline phase, by the way, because still we are producing. Then there is post decline. Post decline I shared with you in my introduction. There will be disposal cost of your machineries, decommissioning cost, then cleanup, environmental cleanup cost. Alright, some portion of some cost can come in any stage. Okay, so design can also come in testing, design and testing can also come in introduction phase, but proportion of that will be little lesser. So some disposal cost may come in maturity phase. Okay, so proportion of that will be lesser. Another new concept here is, you remember BCG matrix? You remember that BCG matrix? So we have linking with BCG matrix. One is here we have market size, or you can say growth. Market size, which is say high here and low. And then we have market share, which is high here and low here. So if you remember the cells in the BCG matrix, do you remember this? Cells in this BCG matrix, so when share and growth both are high, the stage is called as star. When share is high, growth is low in the market, this is called as cash cow. When share is low but growth is high, this is question mark. And when both are low, it is dog. Remember this? So now my question is, if I ask you to relate product life cycle over here, so which cell name goes with which stage of life cycle? Like star will be introduction or growth or maturity or decline. So can you think of which cell here is linked to which stage of life cycle? Can you give me any answer? So like I'll help you with first one, which is very easy. If you are not having any market share and all customers also are shifting to somewhere else, that means growth is also low. So if both are low, if you remember, this should be what? Decline phase. Like one I have given you for help. Now you think for rest 3. Will you be able to? Any answers, guys? So I'll help you. Question mark is introduction. So we have just started. Market is big. Our share is very low. Star is growth. We are also growing. Market is also growing. And when we have reached our saturation, market is not growing anymore. Market has started shifting to somewhere else. It is cash cow. This is maturity phase. Great. No, star is not introduction. Question mark is introduction. If introduction would have been star, we would not have given effort to increase our share. From introduction, you go to growth. From growth, you come to maturity. From maturity, you go to decline. From decline, if you want, you can revive this product by introduction. It's like anti-clockwise, okay? It's always anti-clockwise. Anti-clockwise. All right. So this is again something new from your new ICAI mat. So I'm covering everything with you from new ICAI mat also. That's why it was not printed in our notes. So I'll keep giving you some notes of these kinds, whatever, wherever is applicable throughout this batch. So next are two, again, very hardcore theoretical discussion. Benefits of product life cycle and uses of or importance of life cycle. Both sounds very similar. We have always read like this, no? Benefits, uses are all same, but it's not. So when we are talking about benefits, it's giving you a deep understanding of product profitability. It gives you accurate feedback. Feedback as in what you were planning to achieve and what you are actually achieving. Then cost reduction and revenue expansion opportunities are more apparent when you actually break your calculation into different phases. You understand what is the cost and what is revenue in each phase, so you get more opportunities. Increased visibility of non-production cost. So since you are allocating everything to the cost of product, so you get to know how much non-production cost my product is having, and it is more of long-term rewarding in contrast to short-term, because here the focus is on enhancement of profitability over life. You cannot just think of profit over a specific phase of life cycle. So what are the uses? It can be used as a planning tool, because characterizes, do this correction, it characterizes the marketing challenges in each stage and instead of and you write that poses major alternative marketing strategies. Okay, so as a planning tool, it will help you to identify each stage problems and the solution to each stage so that you can plan beforehand. As a control tool means you should be able to compare your performance. So here they are talking about comparison with some other products life cycle, or you can also compare with your estimated plan of your different stages of life cycle with actuals. So here they are saying company to measure product performance against similar products launched in the past. It will be past. Do this correction. As a forecasting tool, it is less useful because, see, usually when we are talking about importance, we keep talking in favor, but here we are not talking in favor. It is less useful as a forecasting tool because what happens in reality is, this sales that we are showing you here in a clear curve, in reality this is not like this. It's like your stock market curves, ding 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 ding, something like this. So that means there is a lot of diversity. There is no such possibility to predict your pattern. If it would have been a straight line, you could have predicted, but if it is a curve, it is difficult to predict. So we say sales histories exhibit diverse pattern, and sometimes stages also vary in duration. Like you cannot have equal periods of each stage. Sometimes introduction lasts very longer, sometimes very short. Some products can have just a life cycle of 1 year. It may happen. Life cycle of 1 year, and in that 1 year they have skimmed. It may be possible. They have reduced the price from very high to very low. And usually in your life cycle notes, these 3 points are there. But in that question 6 of DJB, a 4th point was there which was not there in ICAI material. So I noted it from there, that it can be used as an analysis tool. Analysis tool as in what? It suggests us which strategies organization needs. Like analysis is about if you should have basically evaluation of different strategies here. Evaluation of different strategies in order to compete successfully. Alright. So in planning and analyzing, you will see that there are a lot in common, but still we are writing it as 2 different points. Here also we are writing about strategy, but here what we are talking is we are evaluating different strategies. Here we are just identifying. Planning is about identifying. Planning and analysis works together, by the way. So in exam, if you by the chance miss the 4th point, no worries, because planning actually covers analysis in usual circumstances. Okay. So after this, I want you to take more notes. Please write in small handwriting, like you make cheat papers, in that type of handwriting. Factors to maximize product returns over life cycle. So if there is a question on this, how will you write? So first is we talk about value engineering at design phase. Say if you are launching a product, it has already passed through several design iterations. So you should not agree with a design that is costlier. So you should do most value engineering at design phase. It has got its own limitation that you know from target costing, but the benefit of this will be the cost that will be committed, to commit the cost as low as possible, to commit the cost as low as possible. Secondly, reduce the time to enter into the market. Now, if say you are continuously doing designing iterations and you are not launching, so consumer taste and preference may change at any time. So you should reduce the time to enter into the market, so that increases the life of the product. Somehow it's connected to target costing. Lastly, maximize the life cycle, especially the growth stage. So try to be in growth stage as much as possible. Means keep strengthening your supply chain, keep your price intact. Like, don't reduce price just to capture more and more market immediately. Before maturity, keep strengthening your supply chain. Okay, so that usually we do in introduction, but if you do more of work in introduction work also in growth stage, so the growth stage lasts longer. You see, our strategies were saying that strengthening supply chain happens in introduction. I say that you keep doing this over here also, so that you are more in your growth phase for a long period. Okay, you should try to reach maybe from your domestic market to international market, from one continent to another continent. So for everything you will need supply chain, right? So that will help you to increase the growth phase. So there are some key points. One is value engineering, reduce the time to enter into the market, or you can say time to enter, and third is maximize growth phase. Then there is another notes, characteristics of life cycle, characteristics of product life cycle. Now you have studied benefits, now I am teaching you characteristics. Characteristics you have already seen with me for different stages, but what about the life cycle as a whole? So there are 6 points here, so we will write it in 2 columns. Okay, first is, it helps us to understand that products have finite lives and passes through different stages at varying speed. Second, this life cycle concept predicts cost, revenue and profit throughout the life cycle. Third, average cost and profit per unit varies throughout life cycle. I am not writing, it's implied. Fourth, different threats and opportunities with different strategic actions. Of course, at different stages of life cycle. Next, different emphasis on each stage. So what is the emphasis in our introduction stage? Is to create more and more awareness. Emphasis in our growth stage is to strengthen supply chain, create more channels. Emphasis in decline phase is cost control. Emphasis on maturity phase is your R&D, feature enhancement. Okay, so each stage can have different emphasis. Now emphasis will differ from product to product. Now in your institute mat you will see that they are writing R&D in introduction. Okay. So that is their interpretation, not a problem. Whatever you write, you have to convince the examiner with your logic. It's not that there is a standard rule that R&D is only the emphasis. So it's just for instance I have highlighted. Lastly, you should seek for new uses. New uses is called as product extension, so that your same customer is more and more dependent on this product. This sometimes brings upon new buyer also. Like if your phone can work like a good camera, so it's a product extension. So somebody buying a camera, a premium camera, may look for buying a premium phone if it has a good camera. Next is new users. You must search for new users for the same product, which we call as market extension. We call this as market extension. That means you are adding new users to your product. Third is increasing consumption of existing users. Increasing consumption of existing users. So if say you are able to do something by which your customers are consuming more. Example is Jio. See, Jio's main business is selling data. So they are selling data as their primary business. Now they want their customers to consume more and more data. So that's why they came up with Jio TV, Jio Music, Jio Games. So they want their customers to consume more and more data so that they will buy more data. So they are trying to add features in a manner that you consume more of the main product. Got it? You can write the example also. So these are some new additions. All right. Remembering this is very tough. My job is easy. I am here to make you understand. It is easy to remember generally the things, but to remember things specifically, you have to do it twice, thrice. So it cannot happen in a day. Whatever mnemonics you make and whatever way you learn, it cannot happen in a day. You have to do it twice and thrice. So next is our next concept, This is very important, very favorite of exam. What they ask here is, they will ask you selling price and cost per unit related question, that why and how they change during different phases of life cycle. Why they change and how they change. So first, for selling price, you understand, it flows from, okay, that means higher to lower. In introduction phase, it will be very high. In growth, it will be high. In maturity, it will be moderate. In decline, it will be low. So how do we get to know that we are going into growth phase? The moment we decrease the price, we are into growth. The moment we further decrease, we are into maturity. The moment we are bringing it to lowest possible price, we are in decline. Okay. Next comes cost per unit. It goes from high to low and then high. Very high to low, then high. Very high in introduction phase, then high in your growth phase, very low in your maturity phase, and then again high in decline phase. Now, what are the reasons? Like in first introduction phase, why do we have high price? Because we want to sell it to premium customers, not to all. We want to recover our initial R&D cost. In second growth phase, why do we reduce the price? The reason for that is we want to get more buyers, and also competition is starting, so we want to reduce the price. Third is moderate, that means the price is brought to moderate level in order to capture more market, match with competitors' price also. And lastly, why the price is getting low? Because nobody is buying. Product is obsolete. There is a change of preference. So we have kept the price very, very low. Why cost per unit is very high in initial stage? Because there is high research cost, high initial cost, high promotional cost. So you can write about high initial cost here also. That's not a worry. But selling price was initially high because we were selling to rich class esteem value customers and we were doing skimming. Okay. Cost per unit is high because of high initial cost of fund, R&D cost and high promotional expense. Okay. So why did the cost reduce in the next level? Because of economies of scale, learning effect. Alright. Economies of scale and learning effect. Learning effect is a separate chapter that we'll also do. Why the cost became subsequently lower? Because of higher economies of scale, efficiency and reduced promotion expenses. And why did the cost started becoming high again? Because we lost all economies of scale and we increased our promotional expenses, high promotional spending and lost benefits of scale. Got it? So this is very important. You have to remember this. Very easy to remember also and very easy to write also, but very, very important also. Last concept is customer life cycle. It is a new concept emerging in real world, not there in your institute mat. It's just an extra knowledge from me. You remember that you have learned with me in previous chapter customer lifetime value, which is equal to present value of cash flows over life. So here you remember that example that I shared with you, that in a college the life is usually 4 years. Now in customer life cycle, what we are thinking is, how can we increase this life? In customer lifetime value, we're just calculating the benefits from this life period, but in customer life cycle concept, we are trying to figure out how this life can be increased. So can we build a new product which will be required post this 4 years and give these customers some kind of loyalty benefit so that they come to us? So if that we can do, the life will increase. So this is the concept of customer life cycle. Again, there can be ways of distributing this into different stages. Okay, life cycle stages, like I will share some. This is not there in your syllabus, but still there are stages like the customer becomes a subscriber, they become a lead, they become converted as your customers, then they become your evangelist. Evangelist means advocates. That means they become your word of mouth, they become your indirect advocates, brand ambassadors, who start promoting your product because they have believed on you, used your product, they are very satisfied from you. So these are some of the stages. So you want that these evangelists should again become our customer. Why should they leave us just after becoming an evangelist? So say for instance, in my case, you are my student today, so you are my customer today taking my service. After completion of syllabus, you will become my evangelist. So I will offer you some new courses which will help you post qualification. So then again I will try to make you my customer. Alright. So these are new real world concepts which are coming into scene. So it aims to extend the life cycle of a particular customer so that they become more profitable. Does this by, one of the example is encouraging loyalty, building new products, something like this. Now, until now you have seen only theoretical stuffs, right? So there is obviously a lot of practical from this chapter which talks about calculating profitability of the product over the lifespan. Which talks about calculating profitability of the product over the lifespan. So while calculating the product profitability, there are some special notes. I'll give you that here. Please take a note. Profitability over life cycle. While calculating this, there is just one thing to remember, that we have a habit of calculating depreciation per annum and charging to profits. So I say here the entire cost of plant, and machinery or research and development is charged to the product life cycle volume that is, we don't amortize or take depreciation per annum. Alright, so you got to charge the entire cost. You got to charge the entire cost to the profit statement. So question is giving value of plant is 20 lakhs. So charge entire 20 lakh. Okay. Similarly, the salvage value, if any, is treated as a cash inflow over life in full amount. So you should not amortize it again. Okay. Opposite to skimming is another way of pricing which we will take up in our pricing chapter. I would just like to mention here penetration pricing. Penetration pricing is something that Jio followed. Usually this doesn't happen in case of innovative products. It happens in case of the products that are pre-existing in the market. So there what they do is they make such a strategy that they will directly enter into maturity phase. So this happens through penetration. So this can be done only by starting with a very low price, like the price at which immediately the customers will start shifting into your product. This price can be sometimes below the cost. So we'll talk about this little later in our next chapter, okay? So with this I have completed the entire discussion on this chapter. Small discussion but very concrete and very relevant for your exam. So we are doing very small chapters and that are super relevant for your exams. So let us come to our next DJB book. See some questions now. I will start with question number 1. Please come to question 1. P&G International has developed a new product A3 which is about to be launched into the market. Company has spent rupees 30 lakh on R&D of the product A3. It has also bought a machine to produce the product A3 costing rupees 11,25,000. So these two are supposed to be completely your cost without any amortization. With a capacity of producing 1100 units per week. So our machine has got capacity of 1100 units per week. Machine has got no residual value. Company has decided to charge price that will change with cumulative number of units sold. So cumulative sales, if it is within this range, this will be the price. Based on these prices, it is expected that sales demand will be as shown below. So this is your sales demand. Many times we mistake this as sales demand. This is just an indicator of price. Sales demand is here. So first 10 weeks, this is 10 weeks. Sales demand will be 220 per week. Our capacity is to produce 1100 units, but we are producing here 220. So in first 10 week, total sales demand will be what? Total sales units will be what? 2200. In next 10 weeks, 550 per week, so into 10 is 5500. Then in next 10 weeks, 21 to 30 is another 10 week. Demand is 825, so 8250. Then here you see it is 40 weeks. 40 into 1100 is 44,000. Then another 10 weeks it is 8800. Then another 10 weeks it is 6600. Another 10 weeks it is 4400. Another 10 weeks it is 2200. So nil. That means these are our total demand. This much we are going to sell. Alright. So based on this sales now, if you want to figure out what will be the price of these sales, you will have to follow this table. And this table is working on cumulative sales. So let us make another column of cumulative sales. So should we make it here? Of course, but with pencil, or you straight away start in your copy as I already informed. 2200. 7700, then to this if I add 8250, 15950, 59950, 68750, 75350, 79750, 81950. Okay, so you can now understand what will be my selling price at each of this stage. So until 2200, now follow this table. Price is 750. For 2201 to 7700, that means from 2201 to 7700, this is the range. Price here is 600. From 7701 to 15950, price here is 525. Okay. Now next 15951 to 59950, the price here is 450. फिर 68,750. After this they are saying post 59,950 it is all 300. So 300, 300, 300, 300, 300. Okay. So we got the selling price in different time period of our product's demand. So unit variable costs are also given, which are given in some slabs. First 2200, 375. So let's understand this here. Variable cost first 2200, it's matching with our first 2200, so price is 375. Next 13750 is this two together. So that means the price here, variable cost here will be 300 and 300. Next 22,000 and next 22. This is something unique here. What we have here is a complete 44,000. Okay. So in order to take the cost, we need to break this 44 into two parts, 22 and 22. So here also 22,000, here also 22,000. So we have here 225 and 188. Then thereafter it is 225. So after this 225 4 times. I hope you are able to make out. It's very tiny. But it's clear. I think I've written it all clear. Okay. So idea is we are actually understanding that some sales price is changing, variable cost is changing, price is, see from high to low, and cost is, if you see what is happening with cost, high to low and then again high. Cost is like life cycle pattern, price is also life cycle pattern. The only thing is they are not mentioning anywhere where is the different stage. So now it's coming. PGIL uses JIT production. We have a separate chapter on this, don't worry. But right now you just understand that this means sales is equal to production. That means there is no inventory. Following is the total contribution statement of the product A3 for its introduction and growth stage. So they are giving some details about introduction and growth. They are saying introduction is first 10 weeks. Why? Because price is same. As soon as the first price will break, that means new phase has started. So first 10 weeks they are saying it's introduction phase. So that their units sold is 2200, correct? 2200 we can also see. Price is 750, variable cost is 375, 750, 375, contribution, total contribution. Next for growth, they are taking 11 to 30. 11 to 30 means this two together is growth stage. In growth stage, we generally decrease the price, okay, so that is applicable. So if you see, total volume in growth stage is 11 to 30. If it is showing, it is having two different reduction in price from 600 to 525 also. So this is together growth stage. So I told you before also that you can always have multiple price reduction in a single stage. It doesn't mean that you can only reduce a product's price only 3 times, from introduction to growth, then growth to maturity, and maturity to decline. It's not like that. You can always decrease price multiple times within a single stage. So they are decreasing twice. So since two different price are applicable for two different volumes, so they have broken it into two parts, 5500 and 8250, 600 and 525, and then 300. So contribution is there and total contribution is there. Got it? Now, what is the question here? Prepare the total contribution statement for each of the remaining 2 stages of product life cycle. Total contribution statement for each of remaining 2 stages. Now, point is, remaining 2 stages is not mentioned. You have to identify where is your remaining 2 stage. So, where do you see maturity, from which period to which period? And where do you start seeing the decline? So in maturity, you see your capacity is fully being used. Your capacity was 1100 units per week. So that must be maturity this entire period. The moment the sales volume starts declining and you have reduced your price also after this, and your cost has started increasing after this. So this entire period indicates decline phase. Alright, so in this decline phase, you will see same selling price, same variable cost, right? But in maturity, you have got 2 parts in terms of your volume. So you can break it up. Okay, it's very easy. You need not write this because it's written well in the solution below. Just follow with me the working, maturity and decline. Maturity we are breaking into 2 parts. The reason of that is we are having 2 different cost structure for 2 different parts. And decline phase is decline phase is the remaining units. How many units it will be? You can add all these units: 8800, 6600, 4400, 2200, 22,000. It's coming 22,000. Okay, so we have selling price. Let us match here. Selling price for 2200 and 2200 is 450, and variable cost is 225 and 188. 22,000 and 22,000, 450 in both. Variable cost is 225 and 188. And decline stage is 300 to 225. Price is fixed, cost is also same. So you can find the contribution per unit, multiply with units to get the total contribution, and it is done. Easy. $81 to $90 is decline, correct. So you can check the result, not 81 to 90, it's 71 to 110 is decline. 71 to 110 is decline. 31 to 70 is maturity. You were at your peak. So the moment you start coming down from your peak, it is decline phase. So you can see the solution. It's perfectly done. What are the next two questions here? Find price, discuss pricing strategy of product A3. What strategy they are following? We have learned only one strategy as of now, which is skimming. So they are skimming. Why? Because the price is being reduced from one stage to another to capture more and more market. So what discuss actually ignites us to write more and more, but you need not write more. It's just of 2 marks question here. So pricing strategy name is required, and skimming is actually recommended when you have researched for a new product, and here the company has researched for new product that you already know. It has spent huge amount on R&D. So if it is selling from the very beginning at low price, and then if say market is not well captured, then whole of research will become a loss. All right. Next we have find possible reasons for changes in cost and changes in cost during the life cycle. So I already shared the notes with you, that important notes at last that we discussed, that why cost is changing in different phases of life cycle. In initial stage, introduction stage, it is very high because you are having high promotional cost and high R&D cost, and then in your growth stage it is lower because of economies of scale and learning curve effect. In maturity phase it goes further down because of higher economies of scale, efficiencies, and less spending on promotion, and in decline phase it starts increasing because you have now more spending on promotion. So all these are already written here well, so you can read it once. So just read once, self read, but all the crux has been already discussed with you. In decline phase you can also write about we have lost all economies of scales. This working is also done, which I have done for you here. This same working has been done in your working note. All right. So you see, easy question. Just the trick was from when to when maturity is there and from when to when decline is there. This was the trick. And also the trick was to read the question for cumulative sales, identifying price and cost at each stage. All right. Then question number 2, I'm leaving it for your self study. It is again the same question of why price and cost changes occur in different stages of growth and maturity. So it's the same thing being written for a different case study related to some IT company. So this is very easy. Again, I will say growth stage, why unit selling price is likely to be reduced. What are the reasons? Okay. And why unit production costs are also getting reduced. What are the possible reasons? So you can read more information over here. Okay. So you have to write 2 lines about selling price and 2 lines about production cost in each stage. Some points that is written here, you may find that we might have noted in our notes in our different stage. It might be possible. Okay. So sometimes while writing this, some characteristic or strategy may get overlapped. So that is an acceptable thing in this kind of answers, but not in that objective kind of answers. 3 I will do with you next session, don't worry. 3 I will do. 4 is same as question 2. Same as question 2. So you need to read it out immediately by the day end, because today everything is very light in your mind and you will be able to easily recall everything. Explain with reasons changes, if any, to unit selling price that could occur if software moves from introduction to growth stage. So what can be the reasons? And in reasons they are also elaborating about some of the characteristics of growth stage also. Identify necessary strategies at this stage. So growth stage has got different strategies, if you can recall. One strategy is strengthen the supply chain, second is value based pricing, third is maintain customer satisfaction and quality. So you will see sourcing new channels, improving quality, changing marketing strategy to increase demand, lowering price to attract price sensitive buyers. So here when we write this in our notes, this is in maturity stage. So you can do some task of maturity stage also in growth stage, that I have always said here. So don't take it as a negative thing. Try to understand like how some things can also be implemented in your previous stage. Okay, 5 I will do later, but 5 you can attempt by your own also. I'll ask you to attempt. I will prefer you that you attempt 5 number. 6 I have already done, and 7 I will do, but 7 part C you can do by yourself. 7 part C is same, unit cost and price. 7A and B I will discuss with you. It requires concept of pricing strategy chapter. Okay, so I may pick it up after doing pricing strategies also, not now, maybe not now. All right, so guys, this is over, and homework apart from the questions that I gave you here, there will be 2 questions in workbook question 2, homework question 1 and 2. Question 1 and 2. Question 1 is after learning curve chapter. See, so many interconnections are there, I cannot help. So after learning curve you will do question 1, but question 2 you can practice. It requires some concept of present value of cash flows. Normally, see, in life cycle what is happening, the product life can be of multiple years. So whatever number of years are there in the picture, it may also invite calculation of time value of money. So that question is asking you to find the present value of your net cash flows over the life. So that is very simple. You find yearly cash flows which is given in the question, and then just take its present value. So that question 2 is important. Why? Because it has been newly inserted in your ICAI New Mat. It was not there in old mat, but it was there in our workbook from very beginning. So we work on the sources of the question from where ICAI is taking the questions. So that we work upon, and we keep taking those questions in our workbook. In our regular batch we take it in our main material also, some more questions that we are not doing with you, but you do not worry about that, because whatever concept is there in that question, that I will do with you. I will not do all the detailed questions of regular batch, okay, but I will do all the concepts of those researched question also. Okay, so that's all for today's session. Everything is complete for today, and gracefully I completed on time this day. I'm expecting you to do your homework. Okay, don't skip it, don't bunk it. The more you bunk, the weaker you become with the subject. So try to give your time, which is very important. Whenever you start next class, make sure that you have done the questions of previous classes before you start your next class. Okay, thank you so much.